Hello, I'm Dr. William Schlosser. You know me as an economist. You may also know me as an ecologist. But more than anything, you're going to know me as an educator. I'm Dr. Bill, and I welcome you to my classroom. When people from around the world think of businesses in the USA, thoughts are often centered on our financial markets, innovation from private sector, and how businesses and the government are linked through our web of commercial interactions. In this lecture, we will look closely at how companies are organized, how we all interact to facilitate new investments and enforce the rule of law. You will find leaders of companies often come from different backgrounds, bringing unique experiences, and serving to grow the investments of their owners in exciting ways. One of the most unique CEOs of the American business world is Steve Ballmer, former CEO of Microsoft Corporation, who currently finds excitement as the owner of the Clippers basketball team. For this introduction, we turn to Neil Cavuto at Fox Business News.
President-elect Donald Trump on his thank you tour, as he's calling it, showing a lot of passion on stage, something that is not lost on my next guest. Take a look. Steve Ballmer! I always wonder how Steve Ballmer feels when you play that video. I love it, and I'll tell you, Steve, and it's great to have you. It shows unique passion, unique energy. Having covered you for many, many years, I think it's a rare quality in a lot of industries, probably all industries, to see passion. You don't see it that much. How are you?
I'm great. How are you? Good to see you again.
Very good. Donald Trump is certainly an outside-the-box kind of a candidate and an outside-the-box president-elect. I mean, he kind of speaks, off the top of his head, barely uses a prompter. You were that kind of CEO before crowds and annual meetings. I guess there are differences in your approach to things. That's probably an understatement. But a lot of people are saying, Mr. President-elect, it's time to dial it back. It's time to start being more presidential. What do you think?
Well, not for me to give advice to the President of the United States. A whole different thing. I do think it is fun for people who are leaders to both have a chance to be thoughtful and serious, but also kind of, feel it a little bit and show people that you're in and you're excited. And in general, I think that's a good thing for leaders as opposed to, being all stiff and formal. But you don't want to look like a madman who has no real thoughtfulness and sort of contemplative nature.
Yeah, but, and I'm not blowing you smoke, Steve, but you could keep people really glued to their seats in an audience, and that is because you did physically glue them into their seats. But no, I'm kidding. But that the idea was, you're trying to jazz a crowd. You're trying to get them into what you're talking about, whether you're talking about developers or Clippers fans. I mean, there's not much difference here keeping them engaged, right?
No, and I think it is really important. When you have a group of people in front of you, they've come, yes, to hear your message, but they also kind of want to be there. They want to be excited. They want to be inspired. And you are right. You bring people to a computer conference, and you want them not only to understand what you're saying, you want them to follow you. You want them to be enthusiastic. We get guys to Clipper games. The number one thing I care about, actually, on the business side of the Clips is how loud we can get our fans bumping and thumping during the games, because I think it's exciting for the fan, and, by the way, it's great for the team.
And it's sold out every game since you've had them, so you're doing something right. Let's talk about
You're not, as a CEO of a company, you're not a Democrat, you're not a Republican, not at least in your business. You're all about Microsoft. You're all about whatever company you lead. The issue we are very focused in on is how do kids who are born in tough circumstances get a shot at the American dream? And there literally are communities in this country where 50% of the kids are, the probability rather is 50% the kids are not going to do any better than their parents. And I just think I think people ought to deserve a better shot. Whether we have Republicans in office or Democrats in office, we're working with everybody on that particular goal.
That's not too shabby. You know, I wonder what you then make of the move the president-elect made to save these 1,100 or so jobs at Carrier. There are a lot of pure free market capitalists, Steve, who said, be careful what you wish for, Mr. President-elect, because you're going to have to do that for everybody, and you're choosing winners and losers. What do you make of that a president, let alone a president-elect, shouldn't be doing this kind of stuff?
Well, I think there's sort of two aspects, and, you know, again, I don't sit in the president's seat, and I wouldn't dare to say. If I take a look, I have another project I'm working on called USA Facts. By early next year, we hope to be able to actually, after 2 years of study, be able to simply tell people, other people other than me, we're trying to learn, where does government money come in, where does it go out, and what impact really does government have? And I've developed a point of view that says there's very little the government can actually do to stimulate the economy in the long run. Yes, interest rates in the short run, yes, spending in the short run, but those things, they blip up, they blip down. There are a few things, and trade is one of them, and you know, the country has to decide on how it feels about open border for trade or less open border. This president will decide, but at the end of the day, I think the inexorable kind of advance of innovation in the private sector is what's going to stimulate jobs in America, maybe jobs abroad too, but jobs here in America.
Thank you, Neil Cavuto and Steve Ballmer, for this energetic insight into the business world of positive thinking and energetic searches for solutions to business and social challenges. We will now take this energy to explore how businesses are organized and financed, and to whom they provide benefits to share information with. In the United States, there are 4 main categories firms are organized under. A sole proprietorship is a firm owned by a single individual and not organized as a corporation. This is the business you might have started as you mowed lawns, sat as babysitter, or sold firewood through. It is the name you put to your services, and it was a sole proprietorship. A partnership is a firm owned jointly by 2 or more persons and still not organized as a corporation. Most law and accounting firms are partnerships. Most large firms are organized as corporations. A corporation is a legal form of business that provides owners with protection from losing more than their investment should the business fail. There are several flavors of corporations, such as the recognized business structure of most companies like Microsoft Inc., Walmart Inc., and ExxonMobil Inc. These corporations have thousands of shareholders and are managed by a team of executives. There are closely held corporations termed S-corporations, meaning a small business corporation generally with fewer than 100 domestic shareholders and only 1 class of stock. A fairly new business organization format is the limited liability company, an LLC, which carries the protections against liability of owners when they act on behalf of the company, but forfeits the ability to raise funds by issuing stocks or selling bonds. In 1977, when the state of Wyoming first passed legislation allowing a new type of company called a limited liability company, hardly anyone noticed. Today, over 2/3 of all new companies formed are LLCs. It is a business structure that combines the pass-through taxation of a partnership or sole proprietorship with the limited liability of a corporation. An LLC is not a corporation. It is a legal form of a company that provides limited liability to its owners in many jurisdictions. Now we'll take a look at each of these business forms. The owners of sole proprietorships and partnerships have unlimited liability, which means that there is no legal distinction between the personal assets of the owners and the assets of the firm. An asset is anything of value owned by a person or a firm, and this includes the owner's investments, savings accounts, and their home. Beginning in the early 19th century, state legislatures began to pass laws that allowed firms to be organized as corporations, and more recently as LLCs. Under the corporate and LLC forms of business, the owners have limited liability. Limited liability is the legal provision that shields owners of a corporation or LLC from losing more than they have invested in the firm. The personal assets of the owners of the firm are not affected if the firm fails. Limited liability makes it possible for corporations to raise funds by issuing shares of stock to many investors. Corporate profits are taxed twice, once at the corporate level and again when investors receive their share of corporate profits. Corporations are generally larger than sole proprietorships and partnerships and more difficult to organize and run. LLCs cannot issue stocks or bonds to raise funds. LLCs are generally about the size of sole proprietorships and partnerships, although none of the business structures limit the size of the organization. Some businesses make their structure using obvious reasons. For instance, a company making a commodity that puts them at potential risk of liability to food poisoning, like a meat canner, or device malfunction that could harm someone, like automobiles, may want to adopt a business form that delivers liability protection. Other businesses that perform services like house cleaning or painting, art galleries or bookstores, will operate nicely as sole proprietorships or partnerships. Although the cost of forming the LLC are similar to the cost of forming a sole proprietorship or partnership, the cost of forming the corporation requires licensing and paperwork at initiation and quarterly to report to the state of incorporation tax offices and corporate records offices. Taxes for the corporation are handled different from the other forms. Revenue to corporations are taxed first to the company and second to the shareholders. They are taxed twice. The corporate tax rates have been higher historically than private individuals are taxed, but corporations are the only business form that can issue shares of ownership through the stock market, and the only form that can issue bonds on the open market to raise funds. We will circle back to this topic in a few minutes. Recognizing these three types of firms in the United States as sole proprietorships, partnerships, and corporations, Panel A shows that only 18% of all firms are corporations. Yet, as panels B and C show, corporations account for the majority of the revenue and profits earned by all firms. Even though big corporations generate most of the financial activity in the USA, small businesses bring the majority of new jobs and represent creative innovation throughout the economy. All businesses struggle to keep employees engaged during economic downturns, and smaller businesses are often more resilient during slowdowns. But they are not immune to the effects of the business cycles. I give most attention to these performance graphs, recognizing how the larger businesses have been able to grow more during expansionary periods than did the medium and smaller sized businesses in the same economic environments. When you picture a business, you think of the founder of the company as someone who owns the business and is involved in the day-to-day operations, someone who makes decisions from the ground up. Then the company grows, incorporates, hires more people, and expands operations, and an evolving business structure is adopted and deployed. Right there, you have introduced the separation of ownership from control. This is a situation in a corporation in which the top management rather than the shareholders, controls the day-to-day operations. The top management of a large corporation does not generally own a large share of the firm's stock, so there is a separation of ownership from control, a problem sometimes caused by an agent pursuing personal interests rather than the interests of the principal who hired the new talent. Corporations are legally owned by their shareholders, the owners of the corporation's stock. Shareholders do not manage the firm directly. Instead, they elect a board of directors to represent their interests. The board of directors appoints a chief executive officer, the CEO, to run day-to-day operations and may appoint other top management. Managers may serve on the board of directors. They are referred to as inside directors. Outside directors are directors who do not have a management role in the firm. Corporate governance is the way in which a corporation is structured and the effect that structure has on the corporation's behavior. Separation of management from ownership benefits the corporation, but can lead to a potential problem from the principal-agent complex. To lessen these conflicts of interest, many firms structure the agent's benefit package to include transfer of corporate stock shares. This serves to anchor the CEO in the same boat as all other shareholders. To earn a profit, a firm must raise funds to pay for its operations. If a small business is successful and the owner decides to expand, it can obtain funds in three ways. First, the firm can reinvest its profits, called retained earnings. Second, the firm can take on one or more partners who invest in the firm. Third, the owner can borrow funds from relatives, friends, or a bank. Unless firms rely on retained earnings, they must obtain the external funds they need from others. The financial system transfers funds from savers to borrowers, directly through financial markets or indirectly through financial intermediaries such as banks. Firms raise external funds in two ways. Indirect finance refers to a flow of funds from savers to borrowers through financial intermediaries such as banks. Intermediaries raise funds from savers and lend to firms and other borrowers. The second way to acquire external funds is through financial markets. Direct finance refers to a flow of funds from savers to firms through financial markets such as the New York Stock Exchange. This option is only available for corporations, as other business forms cannot create stock to sell to investors. Bonds are also only an option for corporations. Together, stocks and bonds are known as financial securities. A financial security is a document that states the terms under which funds have passed from the buyer to the borrower. A bond is a financial security that represents a promise to repay a fixed amount of funds. The interest rate is the cost of borrowing funds, usually expressed as a percentage of the amount borrowed. The interest rate on the bond is equal to the coupon payment, which is an interest payment on a bond, divided by the amount borrowed. The corporation will set the term of the bond and the coupon rate, which is the rate of return the investor will receive if they purchase the bond. The corporation wants to attract investors, so they make the term long and the rate high. But they do not want to commit to it so much that it becomes impossible to honor the bond. These are stated as an annual payment. For example, if the annual payment on a $1,000 bond is $40, then the interest rate is $40 divided by $1,000, which equals 0.04 or 4%. Many bonds that corporations issue have maturities of 30 years. The interest rate that borrower selling a bond has to pay depends on how likely bond buyers think it is
that the bond seller is to default. The higher the default risk on the bond, the higher the interest rate. You will discover that in the world of corporate finance, the corporation is legally bound to honor bond payments before dividend payments can be made. A stock is a financial security that represents partial ownership of a firm. When a corporation sells stock, it is increasing its financial capital by bringing additional owners into the firm. A shareholder is entitled to a share of the corporation's profits. Corporations generally keep some profits, known as retained earnings, to finance expansion. The remaining profits are paid to shareholders. Dividends are payments made by a corporation to its shareholders. A corporation must make promised payments to bondholders before it can make dividend payments to shareholders. Most buying and selling of stocks and bonds involves investors reselling existing stocks and bonds. There is no single place where stocks and bonds are bought and sold. Some trading takes place in buildings called exchanges, but computer technology has spread the trading of stocks and bonds to dealers outside of exchanges. Changes in the prices of stocks and bonds and other securities reflect investors' future expectations. A bond that was issued in the past may have its price increase or decrease, depending on whether the coupon payments being offered on newly issued bonds are higher or lower than on existing bonds. The price of a bond will also be affected by changes in default risk, or investors' perceptions of the issuing firm's ability or inability to make coupon payments. Think about investors who want to participate in business ownership and purchase shares of stock in growing or new businesses. These people will have a super difficult time investigating each and every company to discover details making their risk versus benefit profile look clear. In steps, credit rating agencies. These agencies have ability to discover and report facts about corporations that those companies are obligated to report. Obligations in this case are legally binding on corporations. The reports by these agencies are used to qualify the value of bonds issued by those companies and governments. A conflict of interest was mostly always present, but not realized until the mid-2000s. It came with the mortgage-backed securities scandal that happened when mortgage-backed bonds were rated at low risk and high value even as the assets they were based on tanked. This was the case of the credit rating agencies receiving payment from the firms having a stake in the results reported. A financial stake was anchored to making the mortgage-backed securities a valuable asset. When it collapsed, everyone lost their chair in the musical go-around leading to the Great Recession. Think back to September 2016, as Samsung Electronics was splashed in the headlines with cell phone problems of batteries catching fire as they charged. Even airlines forbid these phones on flights for caution against fire during the flight. Samsung announced a replacement battery to fix the problem. Then in October 2016, the replacement batteries caught fire, and Samsung, instead of accepting responsibility, blamed a battery supplier. For some investors, Samsung was a write-off. By November 2016, the company structured new product releases, reset pricing levels, targeted new markets, and in early January 2017, they discontinued the Galaxy Note 7 line of products, and investors watched as stock prices climbed. Oftentimes, stock performance is driven not only by the book price reported through the reporting agencies, but by the happenstance events of technologies and investor preferences. The performance of the U.S. stock market is often measured by market indices, which are averages of stock prices. The three most important indexes are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. During the period from 1996 to 2013, the three indexes followed similar patterns, rising when the U.S. economy was expanding and falling when the economy was in recession. Note that in all three panels, the vertical axes do not start at zero. As 2017 turned the calendar page, the Dow Jones Industrial Average peaked for the first time ever above 20,000, giving many of us the indication that the U.S. economy is headed into a fresh expansionary period. Before a corporation can sell new issues of stocks or bonds, it must provide investors with information about its finances. In the United States, the Securities and Exchange Commission, the SEC, requires publicly owned firms to report their performance according to generally accepted accounting principles. Some private companies, for example, Moody's Investor Services and Standard & Poor's, collect information from businesses and sell it to subscribers. Investors and the managers of firms need information regarding the firm's revenues and costs, as well as information regarding the value of the property and other assets the firm owns and the firm's debts or other liabilities it owes to others. A liability is anything owed by a person or a firm. The information investors need to know to decide whether to buy the firm's stocks or bonds is contained in the firm's financial statements. A firm's income statement is a financial statement that shows a firm's revenues, costs, and profit over a period of time. A balance sheet is a financial statement that sums up the firm's financial position on a particular day, usually at the end of a quarter or a year. A balance sheet summarizes a firm's assets and liabilities. Subtracting the value of a firm's liabilities from the value of its assets leaves its net worth. Net worth is what the firm's owners would be left with if the firm were closed, its assets sold, and its liabilities paid off. Accounting profit is a firm's income, measured as revenue minus operating expenses and taxes paid. This is the metric used for taxation purposes. Economic profit is the firm's revenue minus all of its implicit and explicit costs. Because economic profit takes into account all costs, it provides a better indication than accounting profit of how successful a firm is. Do not allow the inconsistency of these two statements of profit to confuse you. Accounting profits are aimed to explain and articulate the status of investments and tax liabilities. Economic profits describe how the business is performing in the economy, giving opportunities taken and those avoided. It uses opportunity cost options, implicit and explicit, to evaluate performance. Economists always measure cost as opportunity cost. Opportunity cost is the highest valued alternative that must be given up to engage in an activity. An explicit cost is a cost that involves spending money. An implicit cost is the non-monetary opportunity cost. The firm's most important implicit cost is the opportunity cost to investors of the funds they have invested in the firm. The minimum amount that investors must earn on the funds they invest, expressed as a percentage of the funds invested, is called a normal rate of return. If a firm fails to provide at least a normal rate of return, it will not remain in business over the long run. Firms disclose financial statements in periodic filings to the SEC and in matching annual reports to stockholders. The management of a firm has two reasons to attract investors and keep the firm's stock price high. First, a higher stock price increases the funds the firm can raise when it sells a given amount of stock. Second, to reduce the principal agent problem, boards of directors often tie the salaries of top managers to the firm's stock price. However, problems that surfaced during the early 2000s revealed that some managers inflated profits and hid liabilities. At other firms, managers took on more risk than they disclosed to investors. They complied with generally accepted accounting practices, but did not recognize implicit or explicit costs of the choices they made. In the early 2000s, top managers at some firms, such as Enron and WorldCom, falsified their firm's financial statements to mislead investors about how profitable they were. The federal government regulates how financial statements are prepared, but cannot guarantee the accuracy of their statements. To guard against future scandals, the Sarbanes-Oxley Act of 2002 was enacted, which requires CEOs to personally certify the accuracy of financial statements. Most observers acknowledge that the Sarbanes-Oxley Act increased confidence in the U.S. corporate governance system, though problems during 2007 to 2009 at financial firms again raised questions of whether corporations were adequately disclosing information to investors. It seems transparency has several shades of clarity. The U.S. economy suffered the stiffest financial crisis since the Great Depression from 2007 through 2009. Looking back to the 1970s, financial institutions began securitizing mortgage loans. Mortgage-backed securities are similar to bonds. Buyers receive regular interest payments, which in this case come from the payments made on the original mortgage loans. At first, the securitization process was carried out by the Federal National Mortgage Association, Fannie Mae, and the Federal Home Loan Mortgage Corporation, Freddie Mac. Fannie Mae and Freddie Mac would buy mortgages granted to borrowers and bundle them into securities that were sold to investors. In the 1990s, private financial firms began securitizing mortgages. By the early 2000s, many mortgages were granted to subprime borrowers, borrowers with flawed credit histories, and Alt-A borrowers who failed to document that their incomes were high enough to afford their mortgages. Housing prices soared during the late stages of the expansionary period, but began falling by 2006. By 2007, many borrowers began to default on their mortgages, and many financial institutions started to suffer heavy losses. Many investors complained that they weren't aware of how risky some of the assets on the balance sheets of financial firms were. In fall of 2008, Fannie Mae and Freddie Mac were brought under control of the government. The Wall Street Reform and Consumer Protection Act, the infamous Dodd-Frank Act, is legislation passed during 2010 that was intended to reform regulation of the financial system. The act created the Consumer Financial Protection Bureau to write rules and protect consumers in their borrowing and investing activities. The act also established the Financial Stability Oversight Council, which is intended to identify and act on risks to the financial system. Again, looking backwards to the 1990s, private investment banks began to securitize mortgages. Investment banks had traditionally concentrated on providing advice to corporations selling stocks and bonds, and on underwriting the issuance of stocks and bonds. To address the risks of investment banking, Congress passed the Glass-Steagall Act in 1933 to prevent firms from being both commercial banks and investment banks. This was intended to prevent a conflict of interest. Congress repealed Glass-Steagall Act in 1999. Many of the best-known financial firms remained investment banks. Mortgage-backed securities originated by investment banks were sold mostly to investors, but investment banks retained some of the securities as investments. When the prices of the securities declined in 2007 and 2008, the investment banks suffered heavy losses. Lehman Brothers declared bankruptcy. Merrill Lynch and Bear Stearns were sold to commercial banks, and Goldman Sachs and Morgan Stanley became bank holding companies. The era of the large Wall Street investment banks appeared to have ended. Traditionally, Wall Street investment banks had been originated as partnerships, but by 2000, all had become publicly traded corporations. With a publicly traded corporation, the principal-agent problem can be severe. Some economists believe that the financial crisis may not have occurred if investment banks had remained partnerships.
Enron used to be the 7th largest corporation in the United States, at one point valued at over $70 billion. As of 1997, however, they started losing money and accumulating debt. Instead of admitting their mistakes and making changes, Enron executives decided to hide the losses through accounting tricks because they didn't want the Enron stock price to go down. Risky decisions kept being made, and the truth was hidden under the rug. As of 2001, however, the media started wondering whether or not Enron was overvalued. This obviously put a lot of pressure on Enron stock prices, which used to be as high as $90.75 per share. Insiders decided to cash out and started selling lots of shares, and prices kept falling until they ended up at below $1 in late 2001. In December 2001, Enron ultimately filed for bankruptcy. Approximately 20,000 jobs and $2 billion in employee retirement funds were lost. Many executives were brought to justice, and some of them ultimately ended up receiving prison sentences. Enron was an early example of just how recklessly some corporations are managed. We then had countless other examples, mainly in the financial industry, especially after the Great Recession of 2007 to 2008. Do you see a pattern?
Forwarding now to more recent events, we can look into familiar names like Facebook. The performance of the U.S. stock market is often measured by market indices, which are average stock prices. The three most important indices are the Dow Jones Industrial Average, the S&P 500, and the NASDAQ. During the period from 1996 to 2013, the three indices followed similar patterns, rising when the U.S. economy was expanding and falling when the economy was in recession. We are going to take a short route off our textbook guidance to use some tools I brought to you at the beginning of this semester from Fred. As economists, we are seated in position to discover what interest rates apply to our decisions. This is the detective part of our persona. We can discover what interest rates have been present in our economy for the past month, quarter, year, decade, or longer. We can step into Fred and look at the Producer Price Index to see what businesses have experienced, and at the Consumer Price Index to find the same for consumers. The Bureau of Labor Statistics collects these data and hundreds of others on a daily basis to release monthly statistics about the performance of various sectors in our economy. It is based on the cost of a standard set of goods and services in two baskets, one for producers and the other for consumers. As the cost of goods in this non-changing basket changes, the index values change. Changes in the index cost represents the purchasing power of the US dollar. We will use that purchasing power to reveal the time value of money. These values are reported monthly in each index. Although these indices are not the sole source of determining when the economy is in recession, they clearly demonstrate how factors are interrelated to explain the performance of things like inflation, recession, and expansion. Bring these concepts back to the analysis of bonds in the corporate business world. You consider buying a $1,000 bond with $80 coupon payments, pushing it through with the 10% interest rate, you find a $965.29 value. But what if your rate is not 10%, but instead 5%? Using the same approach, you determined the bond value to be $1,056. The lower your overall discount rate, the higher the discounted value will be. As we convert to stock values, consider there is no sunset date as there is with a bond. You are the owner of the company, or at least a small part of the company, and you will receive the corporate dividends as long as the company delivers. The bond payments are agreed when you purchase the bond. They are set. Stock dividends are based on the performance of the company, so they go up, they go down. They are not set in advance. You want to calculate the value of purchasing corporate stock that is paying a dividend of $50 per year with an expected growth rate of 2.5% per year. Using the 4.545% loaded discount rate and inflation rate calculated several minutes ago, you divide the annual dividend by the difference of your personal discount rate minus the anticipated rate of growth to find the stock value of $2,450, given these specific assumptions. Income statements and balance sheets are part of the bread and butter of accounting operations because they give a snapshot in time of a company's performance. With these reports delivered through time, an investor, business manager, or regulator can gain valuable insights to how the company performs and its long-term potential. We can look into Facebook's records to see what they show to open financial market investors. Facebook's income statement shows the company's revenue, costs, and profit for 2012. Note, negative values are shown in parentheses. The difference between its revenue, $5,089 million, and its operating expenses, $4,551 million, is its operating income, $538 million. Most corporations also have interest expenses and income from investments, such as government and corporate bonds. In this case, Facebook paid $44 million more in interest expenses than it earned on its investments. So, its income before taxes was $494 million. After paying taxes of $441 million, Facebook was left with a net income, or accounting profit, of $53 million for the year. Corporations list their assets on the left of their balance sheets and their liabilities on the right. The difference between the value of a firm's assets and the value of its liabilities equals the net worth of the firm, or stockholders' equity. Stockholders' equity is listed on the right side of the balance sheet. Therefore, the value of the left side of the balance sheet must always equal the value of the right side. As we look into the forms and structures of businesses, we started by looking into liability exposure with corporations and limited liability companies providing a firewall for business owners. We transitioned to discussions to detail several required reporting obligations corporations must adhere to. Some people will consider these requirements onerous and financially burdensome to operations. I have been the CEO of corporations where I was the majority shareholder and founder, and one multinational corporation where I was made a super minority shareholder to avoid principal agent problems. The accounting reports for these corporations were more than regulatory requirements. They were performance verifications, strategy setting standards, and tools used to improve the financial performance. Today, I run an LLC with my wife and one of my daughters as managing members. We are not required to submit the regulatory accounting documentation that corporations are, but we still employ the accounting firm I started using in 1987 to complete the documentation, giving us the ability to grow with targeted intent. I serve on that accounting corporation's board of directors because I know the value of solid accounting records and stock performance. Interestingly, that accounting firm also deploys concepts of determining economic profits discovered using implicit opportunity costs. Really, there is plenty of room on business stages for accountants and economists to work together.